So today, the market just dropped basically across the board. And, a major tech consulting giant took a really serious hit. Plus, we've got these reports of a looming naval blockade in one of the world's most critical geopolitical choke points.
Right.
But, despite all of that, Wall Street's official fear gauge is literally taking a nap today.
It really is, yeah.
Which is just wild to me. I mean, how does a collision of Middle East tension, collapsing artificial intelligence software plays, and a, contracting consumer base result in what is basically one of the calmest trading days of the entire year?
I mean, it seems like a massive paradox, right? Because
Yeah.
you look at those headline numbers and your first instinct is to just brace for impact.
Exactly.
But when you actually look at how institutional capital is, positioning itself beneath the surface, you realize we are not witnessing panic.
No.
No, not at all. We are witnessing a very cold, highly calculated reallocation of capital.
Wow. Okay, well, welcome to the deep dive. It is Monday, August 17th, 2026, and today's stack of notes and market data gives us a really fascinating puzzle to solve for you.
It definitely does.
We are going to unpack exactly why the market took this tactical retreat today, what is physically breaking inside data centers to cause a massive rotation in tech stocks, and what this all means for the week ahead.
Yeah, there is a lot to get through.
There really is. So let's start with those headline numbers just to set the baseline. The S&P 500 drifted down 0.50% today, dropping 40.70 points to close at 7,745.06.
Right.
And then the Dow dropped 272.63 points, which is also a 0.50% decline, landing at 53,459.78.
Yeah, across the board it was.
Yeah, because the Nasdaq dipped 0.30% and the Russell 2000 fell 0.40%. So, I mean, it is a sea of red, but
the actual depth of that red is incredibly shallow.
right.
I mean, context is everything here, because despite the Dow shedding nearly 300 points, we are hovering right near all-time highs.
Oh, true.
The S&P 500 just set a new record of 7,800, just last Thursday.
Last Thursday.
So a 0.5% drop-off, a historic peak, is essentially statistical noise.
It's basically nothing.
Exactly. The much more revealing metric today is the VIX, which, tracks implied volatility. It closed today at an incredibly calm 14.25.
Okay, let's unpack the mechanism of that VIX number for a second, because an index sitting at 14.25 while the Dow drops 300 points and the Middle East heats up, I mean, it seems completely contradictory.
On the surface, yeah, it does.
I look at that setup and I think of like a structural shock absorber in a massive skyscraper.
Oh, that's a good analogy.
Like, the wind is howling outside. The building itself is swaying, which is the S&P dropping. But the dampers inside the infrastructure are, absorbing all that kinetic energy, so the people inside the offices don't feel a thing. They aren't panicked.
That is actually the perfect way to visualize it, because the VIX isn't just some mood ring for traders, right?
Right.
It is a mathematical derivative based on the pricing of out-of-the-money put and call options 30 days into the future.
So it's forward-looking.
Exactly. When the VIX is at 14.25, it means institutional portfolio managers are not willing to pay a premium for crash insurance.
Oh, interesting.
Yeah, they aren't buying up put options to protect their downside because they literally don't believe a systemic shock is imminent.
So they're just holding steady.
Yeah, they are perfectly content to sit on their hands, take a little bit of profit off the table from last week's highs, and just wait for the Federal Reserve minutes on Wednesday.
But, I mean, someone is definitely moving money, because there is one glaring exception to all this calm in our data today.
Right, energy.
Yeah, energy. The XLE sector ETF was the sole clear standout today. It was up 1.4%, while the rest of the market just, bled.
Yep.
And we can trace this directly to the physics of global supply chains. Brent crude surged to $88.50 a barrel, and WTI hit $82.81.
And we know the exact catalyst for that.
The geopolitical stuff.
Exactly. Reports are circulating about a potential U.S. naval blockade near the Strait of Hormuz.
Wow.
Yeah, so what we are seeing in the energy sector today is really how algorithmic trading models price in geopolitical risk before human beings even have time to react.
Wait, I want to dig into that. Are you saying the 1.4% bump in energy wasn't driven by, human portfolio managers manually buying oil stocks?
I mean, not Initially, a massive portion of it is driven by quantitative funds using natural language processing.
So bots.
Basically, yeah.
Huh.
These algorithms scrape global news wires in milliseconds.
Yeah.
And when the models detect phrases like naval blockade and Strait of Hormuz in close proximity to each other,
They just react.
they instantly calculate the percentage of global liquid petroleum that flows through that specific corridor. They know that any disruption shrinks global supply against inelastic demand.
So the trading bots automatically execute buy orders on crude futures and energy equities.
You got it. It's totally automated.
So the energy sector functionally becomes a fortress then.
Yeah.
If you were holding XLE today, the algorithms essentially provided a defensive shield against the broader market slide.
Exactly. And we actually saw a similar dynamic with industrials catching a slight 0.3% bump today, too.
But, if we follow the logical thread here, the physical constraint of global oil supply directly impacts the physical reality of the American wallet.
Oh, 100%.
Right. Like, if algorithmic trading pushes crude to almost $89 a barrel, gas prices go up.
Yep.
And that leads us straight into a much darker spot in today's data, the consumer.
Yeah, the data we have on consumer health right now is it's flashing yellow, borderline red.
Yikes.
The consumer discretionary sector was sluggish today, down 0.4%. But the macro backdrop is what really matters here.
Because of July. Right.
Yes. We just saw the July retail sales report print a 0.6% contraction.
A 0.6% drop in retail sales right in the middle of summer. I mean, now, I can play devil's advocate here.
Sure.
You could argue this is just a temporary seasonal shift. It's July. People are paying for flights, hotels, and road trips instead of buying physical goods at the mall.
Right. The whole shift to experiences.
Exactly. The service economy might be capturing the dollars that the retail economy is losing.
And look, that is the optimistic read. That's the summer vacation hypothesis.
Okay.
But institutional investors aren't willing to bet billions of dollars on a hypothesis.
Fair point.
If that 0.6% contraction isn't just seasonal noise-like, if it is the bullwhip effect of prolonged inflation and high interest rates finally breaking the middle-class wallet,
Then we have a problem.
a huge problem. The earnings projections for the entire second half of 2026 would be completely wrong.
Which perfectly explains the market's holding pattern today, because we are entering the retail gauntlet this week, and the entire market is basically waiting for two specific puzzle pieces to drop.
Right. Home Depot on Tuesday morning and Walmart on Thursday.
And they serve completely different diagnostic functions for the economy, don't they?
They really do. Let's look at the mechanics of why these two companies matter so much right now.
Okay.
Home Depot is a proxy for credit availability and housing turnover. Big ticket home improvements like, kitchen renovations or new roofs, they're often financed through home equity lines of credit.
Right, you're not putting a new roof on your credit card.
Exactly. So if Home Depot revises its forward guidance downward tomorrow, it tells us that homeowners are either tapped out on credit or they're too pessimistic about their future income to take on new debt.
Wow, okay. And Walmart.
Walmart is the ultimate proxy for the velocity of money at the base of the economy.
Because everyone shops there.
Everyone. If Walmart shows a drop in discretionary items like electronics and clothes, but a spike in grocery?
It confirms the trade-down effect.
Exactly. It means the consumer is spending all their available capital just to survive, leaving absolutely nothing for the broader economic engine.
So basically, until Walmart and Home Depot open their books and show us the actual telemetry of consumer spending, large funds are simply reducing their risk exposure.
Spot on. They are trimming their positions, which is exactly why we saw that shallow 0.50% drop in the S&P today.
Man, okay. So we've tracked the physical constraints of oil and the physical limitations of the consumer wallet. Now let's apply that same physical lens to what I think is the most fascinating divergence in today's data.
The AI stuff.
We need to talk about artificial intelligence because the tech sector is fundamentally fracturing right now.
Fracturing is the exact right word. Because look, for the past few years, artificial intelligence has been treated as this monolithic rising tide.
Right, just buy anything with AI in the name.
Literally. If a company had anything to do with AI, its valuation just skyrocketed. But today, the market is demonstrating a highly mature, really ruthless separation between the companies selling AI narratives and the companies building the physical infrastructure.
And you can see it in the numbers. The worst performing sector today was communication services, which was down 1.6%. And that was dragged down heavily by giants like Meta and Alphabet.
Yep.
But the real shocker for me is in software and IT services. Accenture, which is, one of the premier IT consulting firms on the entire planet, they slid a massive 3.3% today. Traders are just aggressively reassessing corporate IT budgets.
It's a huge shift.
But I have to push back on the logic here a little bit. If artificial intelligence is truly the enterprise revolution we've been promised, shouldn't Fortune 500 companies be spending billions on consultants to help them implement it?
You would think so.
Like, why is a massive IT consulting firm taking a 3% haircut on a random Monday?
Well, see, 3 years ago, your logic would have been flawless. During the initial wave of digital transformation, corporations definitely needed thousands of billable hours from junior consultants to write code, clean data, and, integrate systems.
Right, the grunt work.
Exactly. But let's look at the actual mechanism of modern AI tools today. Large language models are increasingly automating the exact low-level coding and data analysis tasks that consulting firms use to charge a massive premium for.
Oh, wow. So the AI is literally automating the consultants.
Exactly. The enterprise client doesn't need to hire a team of analysts to build a custom data pipeline anymore. The AI model can just write the integration code natively.
That's crazy.
So corporate boards are looking at their capital expenditure and making a completely ruthless pivot. They are slashing those strategic consulting budgets and pouring every single available dollar into the physical hardware required to run their own internal models.
Which perfectly explains the winners today. Because while software and consulting bled out, memory and storage chip makers like SanDisk and Western Digital actually gained ground.
They did.
And they didn't just drift higher, right? They issued upbeat, long-term revenue guidance stretching out to 2030.
Because you cannot run a localized enterprise-grade AI model without an absolute ocean of physical memory and localized data storage.
Right. It takes up physical space.
Yeah, the market is waking up to the fact that software margins might be historically higher, but hardware is the unavoidable physical bottleneck of the AI revolution.
Speaking of unavoidable physical bottlenecks, let's talk about Fabrinet, ticker symbol FN.
Oh, yeah.
They are reporting earnings after the closing bell today, and analysts are projecting an EPS of $3.81. Why is this relatively niche manufacturing company serving as the ultimate bellwether for the entire AI hardware space tonight?
To understand why Fabrinet matters so much, we have to look at the actual physics of a modern data center.
Okay, lay it on me.
When you are training a massive AI model, you have thousands of GPUs processing billions of calculations per second, and they all have to talk to each other.
Obviously.
Historically, servers transferred that data using copper wiring.
But copper has physical limits, right?
Severe physical limits. When you push terabits of data through copper at those insane speeds, the electrical resistance generates a massive amount of heat.
Oh, right.
And the signal degrades over distance. The data center literally melts, or the latency destroys the efficiency of the AI model.
Wow.
So the only way to solve the heat and speed bottleneck is to abandon electrons and use photons. You literally have to use light.
Optical packaging.
Yes, exactly. Advanced optical transceivers that convert electrical signals into light, fire it across fiber optic cables, and then convert it back instantly.
And Fabrinet makes those.
Fabrinet is a critical player in manufacturing these complex optical components. So if Fabrinet beats that $3.81 estimate today and raises guidance, it proves that the multi-billion-dollar build-out of physical AI data centers is still accelerating.
Which means the biggest tech companies in the world are still buying the heavy machinery, even as they cut back on the software consultants.
Exactly. It's like, show me the hardware or I am selling your stock.
It really is a profound shift in how capital is being allocated. I mean, we are seeing a complete rejection of abstract tech promises in favor of tangible physical realities.
Yeah, the market wants things it can touch right now.
But, while macro trends like copper to optical transitions and oil choke points dictate the broad strokes of the market, we can never ignore the human variable.
No, you can't.
Because sometimes the most violent market reactions come from individual human drama inside the C-suite. And we had a textbook example of that hit the tape today.
Oh, it really did. Because the algorithmic models, they can predict supply chain disruptions, but they still struggle to quantify sudden human unpredictability.
Totally. L3 Harris Technologies, ticker symbol LHX, plummeted 4.6% in regular trading today. And this is a massive aerospace and defense contractor.
Yep.
On a day where we have credible threats of a naval blockade in the Middle East, a defense stock should be acting as a safe haven. Just like the energy sector, it should be catching a massive bid.
And under normal circumstances, it absolutely would have. But this 4.6% plunge had absolutely nothing to do with defense spending or global conflict.
Right.
It was triggered by the sudden surprise resignation of their CEO, Christopher Kubasik.
Let's look at the mechanics of a drop like that, though. How does one person resigning instantly erase billions of dollars in market capitalization in a matter of minutes?
It's all about risk parameters.
I mean, does the market really think the company just forgot how to build defense systems because the CEO walked out the door?
No, of course not. It is entirely about how institutional risk models are programmed. Modern portfolio theory penalizes uncertainty above literally everything else.
Okay, so it's a blind spot.
Yeah. When the CEO of a massive, heavily regulated defense contractor steps down without warning, it completely breaks the continuity models that institutional investors rely on.
Right, because they start wondering, is there an accounting irregularity about to be announced?
Exactly. Is there a catastrophic failure in a major government contract?
So the market just assumes the worst.
Always. The algorithmic risk management systems, they don't wait around for the investigative journalism piece to drop.
No time for that.
Exactly. The moment the resignation hits the wire, risk parameters are breached, and the models automatically initiate de-risking protocols. They hit the sell button before human portfolio managers even have time to process the headline.
Wow.
Even in a sector backed by deep-pocketed government contracts, human instability is just heavily penalized.
It's a brutal reminder of how quickly sentiment can turn. And, just to round out the after-hours data flurry, we also saw ALT5 Sigma release their post-market results, posting an EPS of $0.42.
Yep.
It's just one more data point adding to the massive pile of information that quantitative models and, human traders are going to have to digest and price in before the opening bell rings tomorrow morning.
And there's a lot to digest.
There really is.
Yeah.
So let's pull all of these complex threads together for you. We started with a puzzle today. A market that is drifting downward, flashing warning signs in the tech and retail sectors, while the volatility index remains completely asleep.
Right.
But when we dug beneath the surface, a very clear structural narrative emerged.
It did. We have institutional capital taking a breath near all-time highs, just waiting for the Federal Reserve. We have algorithmic trading models reacting instantly to geopolitical risks, which is turning the energy sector into a fortress.
Yeah.
And we have a market desperately waiting for Walmart and Home Depot to show us the actual physical truth about the American consumer's wallet.
And perhaps most significantly, we are watching the artificial intelligence narrative collide with the laws of physics.
That's the big one.
The market is aggressively rotating capital out of software consulting and into the companies that actually manufacture the optical infrastructure and memory chips required to keep data centers from melting.
Right. And if you look at the connective tissue of everything we discussed today, it leaves us with a really compelling final thought.
What's that?
Look at the winners and losers today. Crude oil is up, physical memory chips and optical hardware are up, but digital advertising, software consulting, and discretionary retail are down.
Yeah.
We are witnessing a fundamental shift in market psychology. For the last decade, investors rewarded infinite scalability like digital promises, software as a service, abstract concepts.
Yeah, the cloud.
Exactly. But as the macro environment tightens, the market is suddenly demanding hard assets.
The physical reality is suddenly more valuable than the digital promise.
Exactly. The question you really have to ask yourself as you look at your own portfolio tonight is this. Have we reached a turning point in the economic cycle where selling a brilliant narrative is no longer enough?
Wow.
Are we entering an era where you actually have to deliver the heavy machinery, the physical energy, and the tangible hardware to justify your valuation?
That is a phenomenal question to leave on. The infrastructure of the future still relies on the physics of the present. Thank you for joining us on this deep dive to the August 17th data. Keep questioning the numbers, keep looking at the underlying mechanics, and we'll see you next time.